We're seeing that economic uncertainty also play out in the USD, which would normally move higher off the back of the volatility shock that we've seen over the last couple of weeks. Why is it different this time around?
I think it's a question of where the dollar was sitting at the start of the year and relative to where we've progressed in terms of trade talks. And I think there's a couple of really important points. The first of which is that foreign investors held a record amount of U.S. equities. They held a record amount of other assets in the U.S. The size of the U.S. dollar overweight by global investors was among the largest on record. Now, valuation isn't enough by itself, but then you get the catalyst of the trade uncertainty. And so I think what effectively we've seen is a significant rotation out of U.S. assets, out of the U.S. dollar into other alternatives. Now, is that something structural or cyclical? I think it's too early to say, but I think the starting point was extremely aggressive assumptions about U.S. outperformance, which frankly were not sustainable. So I think this change in correlation is really a function of this asset allocation that we've seen.
Not just that, but is it also a reflection of the impact that tariffs have had on U.S. credibility?
I'm sure there's a credibility angle to it as well, and you can describe credibility in the same vein as you might describe as policy continuity or policy transparency. And I think there are certainly questions being asked about those issues. But I think the second question is really also a function of whether or not there are viable alternatives to the dollar. For a long time, over the last 5 or 6 years, people concentrated into the dollar because they felt like there were not alternatives. The European outlook was viewed highly skeptically. Emerging market currencies were also viewed as less viable. And all of a sudden, we've moved into a world where Europe looks more appealing, more attractive. There are certain G10 and emerging market currencies or assets which are viewed as incredibly cheap. So for the first time, I think in a number of years, we're now seeing people think about a more balanced portfolio. I think that's another interesting way to look at this.
So walk me through where the smart money is moving in this environment as well, Eric, because of course weaker dollar, volatility in equities also opens the door of opportunities in some other markets. What do you think specifically it means for us here in the region and for Middle Eastern markets? Does this increase the appeal or appetite for the EM space, particularly in the region?
So I think there's a couple of points there, and you raise a really interesting question, and it was brought up earlier in your program with regards to the momentum around trade coming out of Saudi Arabia. And in fact, we would describe it even more broadly and say that non-energy trade between the GCC and the rest of the world has grown significantly over the last 3 to 5 years. Now look, tariff uncertainty is a horrible headwind for global trade. But there are some bright spots. We're seeing significant trade corridors develop between the GCC and Asia, between Asia and Latin America, Asia and Africa. And that is going to provide some support to EM and some support to the global economy. I also think we need to think about the role of certain countries and cities as super connectors, right? The role that Hong Kong and Singapore have long provided. We're now seeing Dubai and Abu Dhabi start to fill that role as well. And I think that will attract capital to the region in a more significant way going forward. We've seen early signs of it in the last 3 to 5 years, and we think that trend will continue. And that's going to contribute not only economically, but to the depth of the capital markets.
So where is the opportunity specifically? Do you think it's in the public equity space here or more so in the private markets where a lot of investor interest, particularly global investor interest, has centered over the recent months and years?
I think historically there has been a preference for the private markets. There is, I think, historically a desire or a preference from both global investors, but also as well some of the local opportunities to negotiate in the private space. But we are seeing a significant increase in public markets as well. I mean, there's been an increase in debt issuance in the credit space and the sovereign space that has made a meaningful contribution to the depth or the diversity of indices like the MB. And so I think that there's a rebalancing, if you will, probably towards a more evenly distributed balance between private and public. I still think you're right. It's heavily skewed towards the private markets, and that will remain the case. But I think we're seeing a meaningful shift in terms of the opportunities that are available in the public space, especially on the debt side.